Complying with interest rate risk in the banking book, IRRBB, guidelines. Interest rate risk in the banking book, IRRBB, poses significant challenges and requires robust management strategies to ensure compliance with the latest regulatory guidelines. Understanding IRRBB. Interest rate risk in the banking book arises from the banking book positions due to fluctuating interest rates, affecting the bank's financial condition. It's crucial for banks to understand these risks, as they can significantly impact profitability and capital adequacy. Regulatory framework. Regulatory bodies worldwide have developed guidelines to help banks manage IRRBB. These include the Basel Committee on Banking Supervision Standards, which outline risk management principles and supervisory expectations. Banks must stay updated with these guidelines to ensure compliance and protect their financial health. Strategy 1. Gap analysis. Performing a gap analysis is the first step in complying with IRRBB guidelines. This involves assessing the current state of IRRBB management against regulatory requirements and identifying areas needing improvement. Banks should evaluate their interest rate risk exposure, measurement systems, and control mechanisms to close these gaps effectively. Strategy 2. Enhancing measurement and reporting. To manage IRRBB effectively, banks must adopt robust interest rate risk measurement and reporting practices. This includes implementing advanced risk measurement tools, like duration analysis, economic value of equity, EVE, and net interest income, NII, forecasting. Furthermore, enhancing reporting practices ensures transparent communication with regulators and stakeholders regarding the bank's interest rate risk profile and compliance efforts. Strategy 3. Stress testing and scenario analysis. Stress testing and scenario analysis are critical components of IRRBB management. Banks should regularly conduct stress tests to evaluate the impact of extreme but plausible interest rate movements on their balance sheet and income statement. Scenario analysis helps in understanding the effects of various interest rate changes, enabling banks to devise strategies to limit adverse impacts. Strategy 4. Establishing IRRBB limits. Establishing clear limits for interest rate risk exposure is essential for maintaining risk within acceptable levels. Banks should set these limits based on their risk appetite, capital adequacy, and regulatory requirements. Continuous monitoring is necessary to ensure these limits are not breached, and prompt action is taken if they are. Strategy 5. Developing an effective IRRBB policy. A comprehensive IRRBB policy outlines the bank's approach to managing interest rate risk. This policy should include the governance structure, roles and responsibilities, risk identification and measurement techniques, limits, control mechanisms, and reporting procedures. Regular reviews and updates of the IRRBB policy ensure it remains relevant and effective in managing risks. Conclusion. Managing interest rate risk in the banking book is a complex but essential process for banks to maintain financial stability and comply with regulatory guidelines. By implementing robust risk management strategies, including gap analysis, enhancing measurement and reporting, stress testing, setting appropriate limits, and developing an effective IRRBB policy, banks can navigate the challenges posed by fluctuating interest rates and ensure long-term sustainability. Action steps for banks. Review and understand the latest IRRBB regulatory guidelines. Conduct a comprehensive gap analysis to identify areas of improvement. Enhance measurement and reporting mechanisms for better risk monitoring. Regularly perform stress testing and scenario analysis. Develop and regularly update an IRRBB policy aligned with the bank's risk appetite. Want to learn more? Claire Trifle on LinkedIn